The Beatsmiths. Hey everyone, I hope you're enjoying some of that pre-show music. Welcome to another educational session with Matt Maley. Let's get this thing started. Why don't you drop in chat your name, where you're watching from, and some tickers that you're interested in. If you don't have any tickers you're interested in right now, you're just going to sit back and watch Matt give you a bunch of trade ideas. That's fine. That is a-okay. Just let us know your first name, where you're watching from. We get a kick out of having a global audience at these things. We'll get started in just a few minutes. Hey there, everybody. If you are just tuning in, go ahead and drop your first name and let us know where you're watching from, where in the world you are, and we will bring Matt on in just a minute. First, as always, if you are registered for this session and you're watching on Zoom, you will be delivered the recording. But I know you're going to ask a lot. There's always someone that will ask throughout the entire session. And because we want to keep the chat on topic, learning and in sync with what Matt is talking about, if you see one of your neighbors, one of your fellow participants asking, "Will this be recorded? Will I get the recording?" and you're on Zoom, please be a good neighbor and do your civic duty and let them know, "Yes, of course, you will get the recording." Minnesota, Ecuador. Oh, kisses from Ecuador. Oh my god. Jason, good one. Freddie from Las Vegas. We got about 9 yo's from Alex Hogan. 9 Sylvester Stallone yo's. Yo. Give us a yo. Hey. Mexico. Welcome, welcome, welcome. All right, let's bring Matt on. Matt, can you hear me?
I sure can.
Hey, how's it going?
Good. Great to be here.
Glad to have you. So we've got a lot of people very excited. Got some tickers in here. We got some folks from all over the world ready to get rolling on this thing. Matt, I'm going to get out of your way and let you give your presentation.
Sounds great. I'm just going to do my little screen share here and present. I think, oops. Okay.
So far, so good. Looking perfect.
Good. Great. Okay, well, let's get started. I mean, thanks, Pete. The, kind of the gist here, how to trade the stocks like a hedge fund manager. It's just really what I want to try to say is that there's so many different ways to invest, and a lot of people just like to do it in a long term. Everything is 5 to 10 years out and invest in a very passive way, put money in mutual funds, and that's fine. And in fact, everybody should have at least a part of their money and a decent chunk of their money in the market that way. Let some of the pros run that money, and then there's certainly some great ones out there. But if you want to be a little bit more active manager, investor in your own money and trade a little bit more actively, that is a way, done correctly, I think, can really help maximize your returns over a long-term period. And the more you do it, the more you become involved, and the more you learn about it. And it's I say a lot of fun, but it really gets you involved in your own long-term prospects. And it's really just more than just a moneymaker. It's something that really becomes something you can enjoy your whole life. Before I do that, just say a real quick introduction of who I am. And again, I started, besides writing some market letters or investment letters for Benzinga, including the stock picks report, I also am the chief market strategist for Miller Tabak, and here in the U.S. And you may have seen me. I was on CNBC on Thursday. I'll be on CNBC again this Wednesday. I was on Bloomberg TV or Bloomberg Radio. Monday I'll be on both TD Ameritrade and Yahoo Financial. So, but I'm very unique in terms of my strategy work, because most strategists start off, as analysts, group analysts, or covering individual stocks on a bottoms-up basis, or economists. And those people, tend to do very well. But my view is very unique. I spent 25 years, almost 25 years, working on the 2 biggest and most important trading desks on Wall Street as a trader, and covering some of the biggest and brightest, whether it be mutual funds, hedge funds, other financial institutions, insurance companies, et cetera, and really learned about, a lot of strategists really try to figure out, what should happen in the marketplace. And that's great. But I like more so, and obviously I'm always trying to concentrate on what should happen, that theoretical issue, but what is going to happen, what is happening right now, and what is going to happen in the future. And you'll learn that very quickly working on a trading desk, because you can lose money very, very, very quickly. And one of the things that I really talk about constantly is that, there's an old adage on Wall Street where they say the market is always right. That's easily the worst old saying in the history of any business, certainly on Wall Street. The market is not always right. In fact, it's wrong frequently. Actually, in a way, I could step back and say, yes, the market is always right, but it's only always right eventually. And we all know, I mean, was the market right in the winter months of 2000? Was the market right in the summer of 2007? There were obviously, market was dead wrong, was way too high. But the same thing can be said in 2003, 2009, and March of last year. Was the market right when it was was completely washed out and people had margin calls and were forced to sell? No, the market was wildly oversold, wildly undervalued, and it was an unbelievable great opportunity to buy stocks. So the market was dead wrong back at those times. And the same thing can happen with individual stocks. We saw this year with GameStop trading up at $350 and Verizon getting to not Verizon. I'm sorry, CBS. Viacom CBS, and actually I'll mention that stock a little bit later on. But the point is that the market isn't always right, and that's how you take advantage. That's really where you maximize your gains. And to be honest with you, there's a lot of billionaires in this world. Some of them, a few hedge fund managers, but most of them are people who started their own companies and worked for 30 years or more, and that's great. That's a great way to, for those who have done it, it's fabulous. But for the ones who have made their monies, who have become billionaires, whether it be hedge fund managers or even a person like Warren Buffett, who did a more long-term basis, they made their money, but not by buying high, hoping it would go higher. Sometimes they do that. There's nothing wrong with that momentum trading, and we do quite a lot, and I'll show you that shortly. But it's when you get the key turning points and get the stock market when it's just about, or an individual stock when it's washed out and just been incredibly cheap, and that's where Warren Buffett made billions of dollars, is getting these companies when nobody else wanted them, and people were forced to sell, and he swooped in and picked up the greatest thing. So that's what you're really looking for. You're trying to combine a lot of different factors to get those key turning points, but also to make some money along the way in some of the divergences that crop up in the marketplace overall. Well, there's two ways of looking at things, of course, and there's that fundamental analysis. And again, I was saying that the fundamental analysis can be wrong. I mean, the people, last summer, people were saying at the end of the summer, the bond market, the interest rates are 0.5% on the long-term bond yield. It's going to zero. Maybe it's going to negative interest rates. But from what I saw during looking at sentiment issues, looking at positioning, and looking at the technical condition, it told me that the fundamentals were all, even though the fundamentals were pointing for maybe lower, that the economy would slow down more, that everything was on one side, and we were going to see a major shift in the bond market. And sure enough, yields bottomed at that time and rallied a lot further, and rallied strongly from there. And that was enabled me to jump in the bank stocks long before anybody else did. And so these are the types of things that we're constantly trying to look at, that fundamentals can give us a wrong short-term reading. And when that happens, it can really, again, give us some unbelievable returns. So the key is that fundamental analysis is still the long-term play, and it definitely will work. You want to have, when you see the fundamentals turn to the upside, usually don't get confirmation of that until the move in the stocks have made a certain amount of movement. So, but you want to pay attention to both. So once you've captured that kind of turning point, then you got to decide, am I going to stay with this for a while or not? And the fundamental analysis can help you stay with stocks and ride them for a long, long way. Okay, so one of the things that is important is that even though they're very different in so many ways, technical analysis is not just a bunch of lines drawn on a piece of paper. Okay, there are definitely reasons for it. It just shows where if you get down to a certain level and it keeps bouncing off that level, that's telling you that's where the buyers are coming in. That's that for whatever reason, fundamental buyers are coming into that level. Same thing if it bumps up on um, a resistance level, and it can't seem to break above that level. And once it does break above it, it tells you that the sellers are done, and they finally, it's like, no, they're throwing in the towel. They do believe in it, and the stock goes higher. But more importantly, the key thing is that it is fundamentally based. And you think about something as the one thing, the best example that I try to use is you look at a company that's had a situation where they've gone many or several years, they've gone a couple of years where they've had a tough time. They haven't been making much, their profits are down, their sales are down, they've had to lay off people, they've had to close factories, and they've having a tough time. Then all of a sudden things turn up. So what do? They turn around, they go, oh, geez, things are getting better. Demand is much better for our products, or maybe they've come up with a new product that's going to turn things around for them. So what do they have to do? Well, they have to hire more people. Well, it takes time to hire those people. And then once you hire them, you've got to retrain them. That takes time. And what are you going to do? You got to retool your old factories. That takes time. Maybe you have to build a new factory. That takes even more time. The point is, you're not going to see your big turn in earnings for a while. There's going to be a delay. The one thing though is that all these professional money managers, the guys in the the mutual funds and the big hedge funds, they've got an army of analysts to see this in advance. They're talking to the companies, they're talking to the company's customers, they're talking to the company's suppliers, and they realize, hey, these things are turning around for company A, and so therefore we want to invest in company A now because something, these analysts are going to go into the portfolio manager and say, hey, don't wait for these earnings to turn. Yes, the earnings are going to turn 6-8 months from now, but I'm telling you, they are going to turn. Everything's pointing to that way. Let's buy it now. It's because it only takes a second to make an investment decision. It takes, or to implement an investment decision. It takes a long time to implement a business decision. And a business decision takes a long to implement. And so it takes a while for it to show up in their underlying the fundamentals, earnings, revenues, et cetera. The investment decision happens immediately. So those of us who don't have an army of analysts can see something and say, well, wait a minute here, this stock is breaking out here. It's making a nice move. So therefore I can get in now because I'm seeing it break out. And even though I don't totally understand why, because I don't have an army of analysts to tell me that, I do have a good idea on what's going on because we see something in the charts. And it's just such a great way for those of us who don't have those army of resources at our disposal. So that's again. So you can see the same thing happens on the downside because people are human beings. They don't want to lay people off. They drag their feet. But people, the army of analysts see, oh gosh, this stock's going down because their sales are going down. There's rumors that there's going to be layoffs, but their earnings are just the earnings are going to come down later on. And again, you see it in advance by looking at the charts. So it's not just, like I said, it's not just a bunch of lines drawn on a chart. It is fundamentally based and therefore very, very useful. But I thought I'd just talk about each one of these things, just a little bit on certain basics on it. And I know there's some people that are brand new to the investment field and really trying to, or maybe they spend a lot of time really relying on the professional, just putting money in mutual funds and such. So I'm just going to go take a quick moment to go over some of the fundamental issues. The basic issues on the fundamental analysis and then on technical analysis. And then I'll show you how I have pulled them together in the past and how we continue to pull them together now and in the future to make the kind of picks that really have worked out real well. But the first thing, of course, earnings. Everybody knows that earnings are the most important thing when it comes to analyzing a company. You're discounting their future cash flows. That's basically what analysis is. We don't care what a company is doing now. We care about what they're going to do in the future. There was a time when GE was a great company, but their future wasn't too big, wasn't too bright. I mean, they didn't go out of business, and they're making a nice comeback. But it was a very tough stock for a long time. So it'd be a big difference between, and also as we'll see, there can be a big difference sometimes for a short period of time, and maybe, well, I say short period, maybe for several months, where a really good company, the stock of a really good company can be quite not a good stock because it got too extended. And the stock of a not so good company can be a great buy because even though it's not a great company, it's fallen too far. It's fallen well below its fundamental backdrop that you can still make a nice return, especially in the options markets and other areas. Earnings per share, of course, you always hear it all the time. And why do you care about earnings per share rather than just earnings? Well, you have company A is making $10 million a year or $100 million a year. Let's say company A is making $100 million a year, company B is making $100 million a year. They both should be trading at the same price, right? Well, company A has 5 times as many shares outstanding than company B. So therefore, yeah, sure, they're making 100 million shares, but their shares, those earnings are more diluted because they have a lot more shares involved. So that's the reason why I do earnings per share and why it's the most widely followed data point is because it allows people to compare apples to apples rather than apples to oranges. And of course, you hear a lot about price earnings ratio. That's very important, and it's also important to know. There's a lot of times that people get frustrated when an analyst or a portfolio manager or whatever says it depends. Well, it's sometimes a very legitimate answer. I mean, you think, oh, the guy's talking out of both sides of his mouth, but in some cases it's true. I mean, for instance, on a price earnings ratio on the overall market, I mean, right now it's very expensive, 23.5 times forward earnings. There's no question, and that it's expensive, and that's why going forward here, traders and investors need to be careful. But we can take advantage of downside movement too. So, but more on that later. But the point is that when you have but when I started in the business, if it was 17 times earnings, that was considered incredibly expensive. Why? Because interest rates were in double digits back then. Now interest rates are ultra low, so people are willing to accept higher multiples, higher earning PE ratios. But there's also a difference. So as interest rates go up, people are going to have to lower their expectations for what is an acceptable price earnings ratio, and that's one of the reasons why the markets the risk in the market is starting to be quite high. But there's also between groups. I mean, if you have a technology stock, a technology company, or technology group stocks in general, you're willing to accept a higher PE ratio because they're going to go change the world. They're going to going forward, they're going to make unbelievable earnings. So I'm willing to take, there's more risk involved, but the return should be is definitely going to be higher than it would be for, say, a utility stock. I mean, utility stocks, they basically, most of them anyway, almost all of them, have a monopoly. So if you have a monopoly, you can charge whatever you want. So obviously the government comes in and says, no, you're not going to do that. We're going to give you that monopoly. We're going to allow you to be a monopoly, but we're going to regulate what you charge and how much money you make. And so therefore, you're not willing, they're only going to make so much money. The government won't let them make any more money than that. So you're not willing to pay a high PE ratio because their earnings aren't going to explode to the upside because the government has strict guidelines. And of course, you might ask, why in the world would I buy a utility anyway? Well, because people do have a certain amount of earnings, but they're going to make them every year. But people need electricity. I mean, they need their utilities, so it's pretty much guaranteed income, and therefore they pay very high dividends. And so the reason why it is a good reason to carry those names. You're not going to make a boatload of money, but you're going to make some nice income, and it should be part of anybody's portfolio. But again, they're going to have very different PE ratios. And then price to book, I don't want to get too much into it, but price to book is the fair value. We're talking about a lot of value. Value stocks now are taking over from the growth stocks. A lot of these stocks are trading down to their book value. In other words, the sum of the parts. And that's a very, very cheap valuation. And that really helps people again, buy these companies at very cheap prices and go a long, long way. The most important one is price to sales, though, because you can't fudge sales. You can play around with earnings with all sorts of charges and tax issues and things like that. But your sales are your sales. So unless you're doing a Bernie Madoff and completely lying about them, that's what you're that is in my opinion, a much better way to value a company because those numbers can't be played with. So if you got a high price to sales ratio, it's a caution flag, and when you get a low one, it's a great big green flag for a company. And then we always want to talk about the cash levels, free cash flow. Companies that have, we all know, it just makes total sense. If you got a lot of cash, a lot of free cash flow, you got a lot of cash coming in every quarter. That's very good, and it helps buoy a stock. I mean, Apple Computer, I remember in June of 2019, and people were saying, they've lost all their innovation. There's no really new products. Apple Computer is just not what it used to be. And I'm like going, okay, maybe not, but they are generating cash, as that old commercial said, I'm generating cash out the wazoo. And it was like a screaming buy in my opinion. And sure enough, the stock, I was pounding the table, say, buy Apple Computer, and the stock rallied significantly over the next 15 months. And at that time, which was then by the September of 2020, I said that to be careful of those stocks. So that turned out to be a good call on both sides. But the point is, free cash flows are very helpful. And debt to equity right now, we do know that up and coming companies are going to have higher debt. You're willing to accept that, but especially mature companies, they've got high levels of debt. And if we get signs of a recession coming, that's going to be a big red warning flag. So high levels of cash, big green flag; high levels of debt, a warning flag. So these are just some of the fundamental things that we're constantly looking at. And of course, we also have the top down. We talked about bottoms up, looking at individual companies. Top down, of course, you're always trying to figure out what's going on in the overall economy, not just here in the U.S., but in the around the entire globe. And I just mentioned valuations. We've already kind of covered that. That's also important on a broad basis in terms of what levels the market is trading at, and same thing with broad earnings. Group selection, and again, that's very important because what kind of time, what part of the economic cycle are we in that can tell you where you want to be involved in those the growth stocks or in the value names when you're coming out of recession, when those value names can really become very, very helpful. And then correlations too. Obviously there's certain fairly obvious ones where, some seem to be obvious, but they're not good at all. But I like to use ones that are a little bit different. Obviously, higher interest rates are positive for banks. Lower interest rates, not so much, because their net interest margins, they can't charge enough to their own customers. And so lower interest rates are not good. Higher interest rates are good. The dollar, there is a good, strong inverse correlation between the dollar and emerging markets. If the dollar goes down, that's bullish for emerging markets. It's also bullish for commodities because most commodities are dollar based, and if it's a lower dollar, it's less for global economies to buy those goods in cheaper U.S. dollars. So the thing is that we're looking at those inverse correlations. Right now, the dollar looks like it's trying to roll over again, and if it does continue, that's going to be bullish again for commodities, some of which have kind of stabilized recently. Others have taken off, like lumber, but others have stabilized. And they also have a situation where they would help for emerging markets. The other thing, of course, there's ones that not everybody looks at. I look at the Taiwan plastic index for what's going to happen in the semiconductor stocks. So you're trying to look for those things that not everybody's looking at because they can be very, very helpful as well. As for other things, on the overall market, though, let's go to technical analysis. Now, I talked about how it's very much fundamentally based, but it's also momentum based. It's momentum investment, and it's very helpful. But if you use it in and by itself, most technicians are really trying to just catch that 70% in the middle. They don't catch the bottom. They wait for confirmation on the way up, and that's fine. I use that a lot for momentum-based investing, and it can also help us to add to positions. If we get a nice turning point in a stock and you buy some there, you can buy more when you get the confirmation based on that technical analysis. But the point is that we want to be able to try, getting that, if you buy a stock at $10 and it's washed out and it's great, and then it goes to $15, and that's when the technician gets his confirmation that the thing is turned. And it goes to 30. Boy, you're really happy because you've doubled your money. The stock went from 15 to 30. Great. What I like to be able to do is use the combination of fundamental analysis, positioning, sentiment, and technical analysis to get it near close to that bottom. So if I buy it at 10 and it goes to 30, tripled my money. Okay, that's a lot. It's a big difference, needless to say. So it's really helpful to use both of the actors, not just one or the other. So let's just go over a couple of areas, just kind of basic stuff on the technical analysis. Moving averages, you hear all the time about 200-day moving average. You see 50-day, whenever you see DMA, that's what that stands for, a day moving average. So 50-day moving average is another important one. And we hear about golden crosses or death crosses when the 50 crosses below the 200, or a golden cross when it crosses above the 200-day moving average. But these things can be very, very helpful because 200-day moving average tends to be about a year of trading. It's not exact, but if you 365 days in a year, you take out the weekends and holidays, it comes to a little bit more than 200 days. And 50-day moving average, that's about a quarter, about three months of trading. Obviously a little bit more than that. But the point is that these are ones that people watch very, very closely. And I'll show you how there's a lot of examples of how they can come into play. Obviously, that 20-day is more for even short-term trading. But look at this example of Bank of America. Look how this stock, the 200-day moving average, it couldn't break above it. Try it. 1, 2, 3, 4. Really, you could say 5, 6. You get out there. It didn't quite get to it that each time. When it finally broke, it just went whoom, straight up. So you can see this is just one example of many of how the 200-day moving average it can be. And again, you have to look at individual stocks, but as you're following these names, go back into time. You can always set on any kind of service, Benzinga Pro, whatever. You can set the dates, change the dates to go back further, so you can see whether, geez, the 200 days is really more important for this stock, but for this other stock, the 50 days more important. But you can see that when it starts to really, bump up against thing or bounce off of it, if it, in this case it was a resistance level, some cases it would be a support level, so that's just, again, you want to be watching because it can really create some unbelievable moves once they are broken. The other thing, of course, are trend lines. And again, I'm always looking for those, to seek those changes in trends. But the one thing that this gives me an opportunity to also talk about any support or resistance level. You always want to make sure you don't get a slight break. Don't jump to the conclusion that the thing is breaking out or breaking down. If it breaks slightly above, that can frequently be a head fake. So you want to get a little bit more. So if you have a $50 resistance level, the 200-day moving average is trading at $50, and it breaks in, it goes to $50.10. That's not enough. You want to get at least usually around 2%. Some technicians want to see 3%, but 2% above that level to really get the confirmation that the break has taken place and it's not just a head fake. But again, that could be a moving average. It could be any of these certain patterns like the neckline of a head and shoulders pattern, triangle patterns, but trend lines especially too. You want to see a meaningful break. But again, look at what happens here. Here was one of the reasons I was able to double down on my call on the banks. I turned very bullish on the banks in here. We'll talk about a little bit more about that later, why I did that. But then when it broke here, I said, okay, it's just a slight little break there, and not really there yet. It came back down, but then it broke in a more meaningful fashion. You see that? Broke above its trend line. That told me this thing's going to go a lot higher, which it did. You can see that. Look what happened after. It went straight up, and that really got people much more bullish on the bank stocks. The thing is, most of the institutions and the big guys were all, the perma bulls on Wall Street were all giving you the confirmation here saying, buy the group. That's great, okay? But they missed a third of the rally. And so we're going to go into, let me just want to say here, I'll mention that another important issue, but you see, the point is when you can use both technical analysis and fundamental analysis. We liked the banks because they were trading below book value. But then I saw that the 10-year note had become extremely oversold, and the yield had become extremely oversold. Everybody was short the bond market. Everybody was long the bond market in price. They were looking for prices to go higher, yields to go lower, extreme positioning, extreme sentiment. I said the banks, this is gonna change tune. So I made the call here. And actually, I didn't get the exact bottom. I was more in here. And then when it broke out more, I doubled down, and we made even more money there. Okay. The other thing, of course, is a big part of momentum investing is higher highs and higher lows. That's very bullish. Of course, the exact opposite is quite bearish when you see lower highs and lower lows. That's something that is obviously a very bullish, but it gives you an idea of when to run. One of the greatest things about this short-term trading, we get into something, oh, geez, I really like this stock. I'm going to buy it at $30, and I think it's going to go to $40. I'm going to say, if I buy at 20, go to 30. I'm going to make nice 50% on my move. Well, the stock goes to $30, and you look at it, it says, it's been making a series of higher highs and higher lows all the way through. I'm going to let it run. I'm going to maybe raise my stop out level quite a bit, but geez, I've made 50% of my money, and the stock shows no signs of slowing down. I'm going to stay with it. And we see here, that's what we saw here in Darden Restaurants. Obviously it was a big part of the reopening trade. It got absolutely crushed last year. And ever since then, it's making a nice series of higher highs and higher lows. And now that's what we're looking at right now. It looks like it wants to make another higher high. The one thing, though, I'm getting a little concerned because it's getting overbought on a near-term basis on its relative strength index, which I'll talk about in a second. And so I'm getting a little worried there. And so that's what we have here. Geez, if you own it way down here, then it's like, well, I'm going to let it ride. Okay, if it gets below here, yeah, I won't get the exact top, but that'll tell me it'll give it its first lower low. That's when I get out. It's okay. Don't get mad at yourself. That's what the big mistake that people do sometimes. They say, you've made all this money. They made 100% on their money. They doubled their money and they didn't sell at the exact top. So I'm going to wait, bounce one more time. It's like, no, this is telling you it's trading lower. It's made its first lower low. It's going lower. Take at least some chips off the table and don't wait for that bounce. Don't hope. Hope is not a use your rules. Hope is not an investment strategy, and it's not a trading strategy. Let's see, let's make sure. Yeah. Okay. Let's talk about two other things. The oscillators that I just referred to as the relative strength index. That's the again. It shows you. Gives you an idea of what's going on with the momentum. Is the momentum remaining strong, an upward bias when the stock is trading higher, or is it getting is it losing some of that momentum? Same thing on the downside. Is the selling getting over yet? If it's still really strong, it's something that you need to just follow the trend. But when it gets to extremes, on either its daily and especially on its weekly charts, it can really be a good signal that it's just too many people have gotten into it. There's nobody left to buy it when it moves above 70, and I'll show you the chart in a second. Or the same thing when people are selling the stock and there's just too many sellers. It gets below 30. That's a good buying signal. Now let me just show you the exact what I'm talking about here. Okay, whoops. Okay, Viacom CBS. Okay, this was part of the Archegos, the hedge fund or home office that had all the problems here. What a great opportunity. This thing got overbought a couple of times. See, that's the 70 level. That's the red. The reason why that's red is because it's a stop signal. Stop buying the stock, okay? When it gets below 30, that's a green signal, okay? That's why it's green, is because, you should start buying it now. But some stocks that are more volatile, especially like a Tesla, you don't want to start selling it when it gets to 70, and you don't want to start buying it when it gets to 40. You want to see it go a little bit further. But look at the extreme we got in this relative strength on a weekly basis. It almost got to 100. It was the highest I had ever seen. So on my tier 3 call, I came in and I said, okay, you ought to short this stock and buy some put options. Well, sure enough, the stock, those who went short made 60% of their money in just a few days, really in less than a week. And those who bought the put options made 2,500% on those options in just a couple of days, because you don't see things like this very often. I wish I could make a call on that every week. We'd all retire rich by the end of the year. But they do come up some of the times, and when you see those big extremes again, and I combine fundamental analysis by saying, hey, this is a good company, but it doesn't deserve the level it got. It got up because of short covering. People saw the short interest, and it just got out of control, and we took advantage of it to maximize. Again, so if on top of saying I said people should short it, I said if you own the stock, you should sell it. And look at this. You made 5 times your money if you own the stock from down here at the 2020 lows, and you got out at the top. That was great. Then you also made money on the downside. So again, we're looking to make those maximize. We had that big chunk of long, with investment with long-term horizons. For those of us who want to and have the ability to trade on a shorter-term basis, can really take advantage of that. The next one here, see Tesla, the same thing. I really wish this chart it only goes through the end of 2009. That's my fault. But you see how the RSI got incredibly oversold. I came back in here and just said, double down. And when this got down to here level, I was pounding the table. You ought to buy this stock. And of course, the stock went up several thousand% from there until I turned more cautious on it in August of last year. So again, this is a great way, no matter what you think of the long-term fundamental picture on Tesla, I mean, even if you think they're going to zero, when a stock gets this oversold, unless you think it's you think it's a Bernie Madoff type of situation, you can buy it. There's not a lot of people who think that Tesla is going to go out of business anymore. But back then there were some who did, and I'm like going, I don't care what you think about it long term. If you hate this stock, I don't, is what I said. But if you've got to buy the stock, it is going higher. And that was another thing. I didn't know it was going to go up 2,000%, 2,500% over the next year. But what we did, we just kept riding it, and then we kept raising our stop out level, and we just rode it all the way into the universe, into the stratosphere. And then there was some other issues why I turned more cautious, and we took some profits there. I mentioned Darden Restaurant. Remember, I said why this is one of the reasons. It is getting a little overbought, and you see that each time it got to this level, it is sold off. So I'm starting to get a little cautious on that Darden Restaurant call. But let's just move on to the next issue, was MACD, and this will really be the last one. And then I'll just show you a couple of the stocks that I picked and how it's worked well to combine all these things. And then we'll let you guys give me some names, and we'll talk about that. But anyway, the MACD chart. And again, it's called Moving Average Convergence Divergence Oscillator. It's basically, I like to compare it to a golden cross and a death cross. It has this, you have this 26-day, and that's 20-day, moving average versus this 12-day. And when you see these short-term crosses, it gives you a buy and sell signal. And we also, we combine that with higher lows and higher highs. Oops, there we go. Oops. Apologize. I thought we'd have a chart there, but I'll show you that in a few minutes. But anyway, let me just see here. Okay, I'll go back to that. But it's just another one of these things like the RSI. When it gets to a certain level, it really gives us a good indication. And I will show you some charts really just in the next couple of minutes. I'll show you what I'm talking about. Just the one last thing to mention, these sentiment polls I mentioned earlier, the commitment of traders, COT data, that is something that it tells you where the futures traders are positioned. And, if they're long, and that's fine. If they get long to extreme, it just shows you, especially we look at what's called the speculators. They're the ones who usually are the ones that are wrong when the market's at extremes, because they're just speculating. They don't know what's going on in that business. The commercials are the ones who are actually in the business. So the commercial traders, for instance, in the oil companies and the oil futures, they're the ones who work for oil companies, and they're trading. They really know what's going on in the business. So we pay attention to them. They're right at extremes. The specs are wrong. And so when we see that kind of data, we saw that this past summer, at the end of the summer, when the futures traders were loaded to the gills in bonds. I knew they had nowhere else to go. Also, another thing, of course, we look at is short interest, where if there's a big short interest for a stock and we like it, that could give it a bigger boost. What we've seen recently with GameStop and AMC and some of these others are not ones that no, they don't work as well. They work well, not as well as they did in those situations. So be careful on that, but it's still a good indicator to use when among other things. The other one, of course, is sentiment. And again, I look at situations like the DSI poll. That's the Daily Sentiment Index, and that polls futures traders. Again, that was another situation where we had at the end of last summer, the bond traders were all loaded to the specs. We're all loaded to the gills in bonds. They thought the price would go up and that yields would continue to go down. They were wildly bullish, 95% bullishness. It was off the charts. Everybody was on one side of the boat. Rates couldn't go any lower. And that enables to make a great call. We also look at the Bank of B of A, Bank of America survey of fund managers, and we see that on hear about it on CNBC and Bloomberg all the time. And they talk about very crowded trades. One of those back in the beginning of the year was the dollar. People were just thought the dollar was going to go straight down, and it was their number one pick was to be short the dollar. Well, sure enough, the dollar saw a 3-month bounce, and which seems to be coming to an end. But it was just very interesting to see. But again, sentiment is a contrary indicator. Only at extremes though. If bulls are starting to get, people are starting to get a lot more bullish and the market's going up, that doesn't mean anything. Only when those bullish sentiments get to extreme levels. The DSI, the daily sentiment, that's usually in the 90s. In the II poll, the Investors Intelligence poll, that's in the 60s. So it just depends on different polls because they have different people that they poll. Anyway, so we've kind of talked about all these different things. Let's really bring it to some specific instances. Here's one where I put a couple of things together. Invesco. On the fundamental side, I love the stock back here in the summer because, number one, they had a big change in their fundamental, the way they traded things. It used to be in the late 90s, basically a technology company investment. That was their big thing, but they broadened that out over the last 20 years. So I like that situation. I also saw that a lot of big banks are looking to take over money managers, and they've been taking over some smaller ones. Invesco seemed to be a good opportunity there. So that was the fundamental picture. On the technical picture, though, I saw how the 200-day moving average, see how I couldn't break above it there? Well, now the stock was much cheaper. It traded in a sideways range. I made my call on interest rates back in here, right? I said interest rates are going to move higher. They started to move higher. This stock broke out of its range, okay, and broke out of that sideways range. So it made a key higher high, broke a 200-day moving average, and it took off. And look what, and then I stuck with it because I did a series of higher highs, higher lows all the way there. Another reason where a couple times it got very overbought, but the reason why I didn't sell it, say take some profits there, was because it's still a takeover candidate, and I don't want to be out of the stock at a time when they get taken over and it opens one day up 30%. Here's another stock. One of the best calls I've made was Microvision. Again, I like that on a fundamental basis. They have two things. Number one, they're into the new development where they have the small enough display mechanism where the smart glasses can really work. I mean, people were saying smart glasses were going to be the next big thing five years from now, but you look like you're in a 1950s sci-fi movie wearing those things. They were ugly, it's disgusting. Now they have this new technology that can make these smart glasses. You can wear very stylish glasses, just like the ones I'm wearing right now. That's very bullish. That was the first thing that caught my eye. But as I looked further into it, I realized it was a much bigger issue on the fundamental side, and that's LiDAR. LiDAR technology. Li is laser, DAR is radar, laser and radar. And that's what you need for all these automatic driving vehicles. Okay, you can't have an automatic driving vehicle that, again, this laser goes out, it's a radar. The laser goes out, it hits these other fields, and that's how you steer. But it's not just cars, it's robots, it's anything you have to do. I mean, you want to have you're going to have a robot is going to be your waiter in the future. Well, they're going to need LiDAR technology. And I'd also note that Elon Musk, because we're not a big believer in LiDAR, but one of his most senior people, somebody's been with him since the very early years, since the beginning, just left this past week, just left Tesla to go to a LiDAR startup. So it was really a good fundamental thing. So there was a great fundamental story, but I was really still, I wanted to see a breakout. Of course, it break up to a nice higher high. I was pounding the table saying, this was the one, this is one of the next big thing, the stock, and look at how much money it's made over the time. It's come down a little bit, but we've been able to trade around it on a short-term basis. Look at this here. We did a Microvision. I got into the stock here. And again, I used fundamental. I love the fundamental story, but look at what, we made 4 times our money, 4 times in just 2 weeks. And look at this RSI. It got incredibly overbought. So I said, you know something? I love it long-term. We're not going to sell the whole position. We're going to sell half. Sell half of everything you have. Okay. And we're going to buy it back at 5. Okay. A couple of weeks later, sure enough, it got down to 5. I said, buy it because I love the long-term picture. Then it took off again. But look at its RSI chart. It got crazily extended once again. So I said, okay, we're going to do the same thing. So we made 844%, but actually we made more than that. We made over 1,000% because we sold half our position there and bought it back at almost half the price. Sold it here. And at that time I said, sell half the position. It got down to here. I said, buy back half of that. So in other words, buy back 25% because it's up to a 75% position. And then I did, I'm sorry, this stock, I didn't have the updated chart, I'm sorry. But just last week, it got back down to 10. So we went back to a full position and the stock closed above 15. I'm sorry, I have the wrong chart up, but now the stock is back up above 15. So it's up in here, it's up in here, not here. So it's worked out really, really well. We've made over 1,000%. Again, using that tier 3, we can make these nice calls. This was a tier 1 call. Called that on my one. And so for some, we've just been sitting on it and you're going to ride it, I think, for many years to come because it's going to be a great long-term play. But we also, for the tier 3 people who want to be really active, we make these different calls where you can really maximize those returns. Now, and look at this here. This is updated, thankfully. But look at this difference between when we got into the stock in early December. The stock is now up 570%. It's not obviously not as high. It was up 8%, but up 570% versus only a rise of 162% in Bitcoin. Now, of course, if you bought Bitcoin a year ago, you made more money in Bitcoin. So I'm not kind of trying to say that Microvision is better, that has been a better investment than Bitcoin, but it has been since we got in it when I made the pick back in early December by a long shot. So again, that's just another one of those things here. Again, here. This is a great example on the MACD chart. Remember I talked about the MACD chart. We got a positive cross here. Okay, stock went up. But here we got another positive cross, right? Another positive cross at a higher level, a higher high. Then we got another positive cross, and this is when I jumped on the stock. A third positive cross at another higher high. That's the fundamental story. So that's what I really liked. I got into the stock here. And then when it broke above here, we liked it even better, okay? Because it made a key higher high. And look how it's really taken off. So that's the technical aspect. The fundamental aspect was that, hey, the economy is growing. I wish I'd gotten it back in here. Sometimes you don't get it when you want, but I didn't notice it until now. You can't notice every single stock, but this stock's up 18%. We've only had it for 3 weeks. Okay, so it's good. I think it's going to go a lot higher. It hasn't done as well as Microvision, but it's 18% in 3 weeks is a real nice play. I think it's got a lot further to go. But as the economy reopens, they're big into part-time hiring. They're a hiring agency, they're an employment agency, but they're also gotten moving much more into long-term permanent hiring, and that's going to be so key going forward. And it hasn't been priced into the stock, and so we had a combination of a nice fundamental story and then a good positive picture. I mentioned the Viacom. We already did that. I'm sorry. And, just to talk about what our best picks have been, I mentioned, Microvision, that's what it's up so far. Riot Blockchain's another one. Invesco, we're still holding on to that. So some real nice games. I only started this letter in August, so it's not even a year old yet. And yet we've still got some huge returns. I mentioned these two not because this is not my 5th biggest one and this is not my 6th biggest one, but I mentioned that because I want to share a couple of these I made several months ago. What have you done for me lately? Well, Manpower Group's been a nice one for us lately. Just 3 weeks ago, and it's already up 18%. And the other one to mention is that you don't always have to. I make 2 long-term picks every month, and I make a intermediate term pick for level 2 4 times a month. You can't come up with that many. The next best thing, there aren't that many of the next best thing. Microvision is one of those things, and it's worked really well. But there's also picks you can make like Walgreens, and Walgreens isn't new. It's not a technology company. They're not going to come up with a drug that saves the coronavirus. But you still, when a stock gets ridiculously oversold, when it gets washed out, it can become, again, in just a few months, I think it's been 4 months here, 41%. I mean, that's a nice move. You don't always have to be shooting for the moon and to really get things to maximize your returns. And last thing is just to hear the tier 3 picks. These each one of these cases, these were ones we were involved in options. But again, these are the returns that we've got. Viacom was put options. The other 3 were call options. And it's just a nice way to maximize return. Obviously, there's more risk involved. Some of these options, they don't work out at all, and it's a big loss. But it's like, geez, if I lose, if I sell it and it goes down 25% in a few days, and I sell it, okay, that you don't spend as much money, but when you get your batting average is way above 500, and you're getting these are your returns on the winners, and more than makes up for it. And that's the one thing. You're going to have losers no matter what you do. The best investors in the world will tell you they've had some bad losers. The key is to minimize those losses. Let the winners rise, or let the winners run, and you go from there. So anyway, that's really my the gist of it. I kind of went a little bit longer than I wanted to. I apologize, but if we want to talk about some names that you want to talk about, or if you have any questions specifically about the way I look at things, but the whole idea is to trade a little bit more. Have that 3 buckets: The one bucket where we do have that long-term 3, 5, 10-year horizon. The middle bucket, the tier 2 product that we have, which is shorter, multi-month, and then the other one, which can be a really short term, and rather a week or two, or even just a couple of days. But sometimes those can turn into those long-term plays when you let them run for a while. And my whole idea is like, it's okay when we let those things run; they really work well.
All right, Matt. Just a reminder to everyone and to Matt, we're at about 9 minutes left here. So we got to cover two things. Number one is let's hit all these tickers that you guys are dropping in here. Would you mind going ahead and pulling up right now? I'm trying to get I'm trying to go back in time to get something that someone asked earlier. OCGN.
Can you see my screen okay?
Yep, you're good there. OCGN.
GN is in Nancy.
Yep, Oscar, Cameron, Gary. So you got OSGN right now. You want to change that? Go back. OCGN. There we go.
Okay, sorry about that.
All good. And then just a reminder. So we're at that 9 minute. We're at about 8 minutes now. Let's hit some of these tickers, do a little technical analysis on them, and then we'll talk about how the subscription works. Answer those questions.
Okay, here, let's go to one thing. See this RSI chart getting a little overbought. That gets me a little concerned, but let's look at the weekly. Yeah, it's interesting. The one thing you want to do with this one, this stock is, I say, geez, it's approaching an overbought level, but it's not extremely overbought, and it usually doesn't fall until it does get extremely overbought. I am worried that it sold off, obviously, on Friday, had this huge run and came back in. So what I'll be looking for is to see if it can rally back above that $10 level next week as we trade in early next week. That should tell us that we're going a lot higher. But the stock looks pretty good, especially because it held its 100-day moving average very, very nicely. That green line there is this 100-day moving average. So at $9 you get, well, and it's a long way to go. But I guess my point right now, though, is that you have a good stop, okay? You buy the stock now, your stop out level is 831 because that's the 50-day moving average. See, that was old resistance. It broke above it, so it becomes new support. So that's key. So now you know what you have a good stop level. If you buy it here, you're out at below 831. And if it gets above $10, you add to that level. Don't be afraid to add to winners, okay? Because you're adding to a winning position. You buy something at 55, it goes to 60, you buy more, you have a $55 average on a stock that's trading at 60. It's a winner. Stay with it. Don't be afraid to add to winners.
All right, and we're getting the question: what program is Matt using? This is the Bloomberg terminal.
Right.
All right, so let's do Palantir.
Okay. And bang. This one, the battle lines are incredibly well defined here. I don't have any of the moving averages in there, and for the right reason, because this is, it's been such a big player in the marketplace for institutions and individual traders. So when you get that kind of, let's see here, oops, what happened here? There we go. You get that kind of influx when you break, and there's so much money in momentum trading nowadays that if you break these levels, it's going to see a big move. So if you like it here, if you like the stock, and I do, it's bounced off this level here twice here, down near 21. Let me just put it in here. I'm sorry. Make sure I have the right level. It's actually 22. You see right here, 22, 21.75. That's going to be key support. It's bounced it off that nicely. So I like that stock. So you start nibbling here. And what do? Well, gosh, I have my stop out level. It gets below 21.75. I'm out. I don't care how much I like it on a long-term basis. I'm going to get out. I'm going to look for another entry level later on. Okay. But now I've just nibbled here because I'm not still sure. There's, obviously it's come down a long way. It breaks above here. Okay. It breaks above here. I drew the rebels at the wrong sign. I'm going to get rid of that one right here. Okay. And that is at, okay, 25.50. I'm sorry, 25.50. You break above that level. Okay. That's going to give it a nice higher high. It's first higher high really since February. Okay. Then you add to the position there. And again, don't be afraid to add. People who add on the way down, all you're doing is adding to a losing position. Instead of adding to it, get out and look for a different level to get back in. Adding to a winning position, it works there. Then you add to it again and get it more aggressive, because this will be an even a really important higher high, because it will also take it above its trend line that's been downward sloping recently. But you get above $27, you add to it more, because it gets above there, it's going to 40, and you're going to have a really nice big position. But it's a way to interest. Geez, if I had bought it all at 23.40, right where it is right now, I would have made a bigger position. But you don't know. You're looking for that confirmation to give you more confidence to add to the position, and that's why I play it that way.
Great. All right. Next up, let's take a look. Let's hit NIO. NIO.
Yeah. Okay. Bang. Now this one is looking enticing. Here's another one where we want to look at the 200-day moving average. Didn't get quite down to it, but it got close, right? Now we can get rid of the 50. Okay. Is the stock, it's not staying a little bought, okay? It did not make a lower low. It looks like it did over here. I mean, but I'm sorry, it made a higher low right here. It got back down, held. Not only did it hold its other low and avoided a higher, and voted making a lower low for the second time, it also held its 200-day moving average. That's positive. So now we're looking to see, can it break above that level, confirm us? So this is a place, again, it's certainly not overbought, even though it's bounced a little bit. This is a place where you can start buying it now. And again, you have your stop level, 35.60. It's 200-day moving average. It gets below that, you want to get out of the stock. Okay. Now that 200-day moving average will change over time, so keep an eye on that. But you get above $42, that April 1st high, that's going to give it its first higher high in 2 months. That's going to give you more confidence that you can add to it. So you add to the stock there. Then you add to it again. Again, same thing as I mentioned on the last one, is that you can add to that, add to those shares. Hold on a second. Okay, now it's already broken above its trend line. So that's another reason. It's bounced off its 200-day moving average. Get that out of. It's bounced off its 200-day moving average. It's broken above its trend line. If it makes a higher high there, we're going to buy more, and then we're going to add to even more of it when it gets above basically 46.50. That was the high from mid-March. It's going back to its old highs above $60. That's what we're looking for there. But we have that strict, the 200-day moving average. It sells. We're out.
Let's hit SRNE, biotech stock.
SRN.
E. E is an Edward. Yep.
Okay. Okay. Now this stock's it's this one's. I'm going to go back a little bit further so we can look at 2017. Bang. Okay. And you can see its 200-day moving average is breaking down. I'm sorry, it's 50-day moving average. The red line is breaking down pretty severely. That's a concern. Get that 100-day moving average out of there. The one thing though is look at each time we didn't quite make a death cross there. It made one there, but only for a couple of minutes. So I mean, it's actually been a lousy signal. Death cross and golden crosses have been a lousy indication here. If this thing turns back up, it's going to be positive. However, having said that, it bounced off its 200-day moving average a couple of different times, and obviously it broke below it more recently. That is a concern. That's going to be that means that it's lost a lot of momentum. Let's look at it a little bit better here. Bang. Okay. What we're looking there is hopefully this thing can turn back up, but if it doesn't, we got some problems. And as we can see here, the lows from April made a very slight. Well, let's look at the stock really quickly. Closing basis. Bang. See here, we're looking at these lows again. This is one, if you like it, that's great, but you really want to be looking. You have a firm stop level, okay? 750. You break below those lows, the low in December and in April. That is a key line. You break below that, it's going to be an important lower low below 60.90. You get out of the stock. To be honest with you, this one looks a little dicey to me. I wouldn't get too aggressive here. You really have to get above $10 before you get a lot of confirmation that it's doing better. And it's really not coming from a severely oversold level. So this one looks a little dicey. But again, if you want to play it here, you have a good level to take your stop out, and so you can limit your downside losses.
All right, let's get one more ticker in, and that'll be it. So we'll do PLUG plug.
Oh yes, the old favorite. Okay, here's a stock that is coming off an oversold level. Now it broke below its 200-day moving average. That's a concern, but not well below it. Okay, it could be a head fake. Let's look at its weekly RSI. Okay, it's not crazy oversold, but it's holding its 50-week moving average. Look at this. Look how important the 50-week moving average has been. Look at the solid support the 50-week moving average has given this stock over the last several years. It got a little below it last week, but it bounced back nicely above it. That's very positive. So, and then I'm going to go and let's look at the MACD chart. We talked about a little bit. Boom. Look at this. It's been trying. It looks like it now might be finally be able to make a positive cross. So if we can get back above that 200-day moving average, which is very close by, that's going to be more bullish from the stock. Let's see, it's 2860, so that's not far away. You get above that, and of course above 27, that's also, as we can see on here, oops. Okay, I'm not thinking, but you can see just by looking at it, you can see that it's now just breaking above its trend line. So it's already doing that because it was such a steep trend line. It breaks above its 200-day moving average. This thing could really go, especially if the MACD chart sees a little bit more of a crunch. So what I'm trying to, same type of thing. And maybe you can nibble a little bit here. Again, you're using the recent lows, which was on basically here in the 2350 range. You get below 2350, you get out of the stock, 10% of that loss. You get out of the stock, okay, and you take your losses and move and wait for a better opportunity. But if you nibble here and then buy it above its 200-day moving average, and then you get above that, really, I just think really anything here above 30, it's going to run. It's going to run in a big way. So there's a lot of potential here. This one's got one that you can play. Again, you can play with a little bit nibbling here. You add more as it moves up. Don't be afraid to do that. Don't be afraid. I can't emphasize that enough. If you're adding to a winning position, and then you can just take your average price as your stop out level, guarantees you don't lose anything, and then you can let it run.
That's a great note to end on. Matt, thanks so much for spending your time with us on a Sunday. I want to, before you take off, I was just wondering if you could share what was one of your most recent picks from the subscription, if you wouldn't mind just going through it. Let us know, what was your buy point, what was your sell point, that type of stuff. If you can recall your latest one.
Well, I mean, Manpower was the one I did mention a little bit earlier. Can
you pull that one up on the chart again?
Sure. Let me just.
Yeah, let's just take a look at that most recent one, guys. And the link to grab the subscription is in chat.
Okay, now here we had a situation where, again, it's I wish I had hold on a second. Well, I'll just leave it here. It's getting a little overbought on a near-term basis, but I'm not overly worried about that because it's I want to get weekly. Anyway, so I combined a couple of things. There. So again, the fundamental story was that I liked that the stock really, even though it's certainly rallied like every other stock in the world, it is a big employment agency, especially for part-time workers. But they've made this big move in the last couple of years, and especially during the pandemic, into longer-term permanent hiring. And companies are begging for people at all different levels, and that's why Manpower has moved into not just people to go work at a local Dunkin' Donuts. They're working for real companies with long time. Real Dunkin' Donuts is a great company, but for full-time work at the executive level, and they really and there's people are trying to get back to work. A lot of other people are looking to make career changes. This is going to be. I'm so surprised. I got the stock right down here. Okay, but again, what I liked it had gotten a little below its 50-day moving average early in the year, but then that 50-day moving average provided unbelievable support all along here. It kept bouncing. I said, oh, this is looking good. The fundamental looks good. Picture looks good. Let's start nibbling in the stock. And then, of course, when it made its higher high, bang, bang, then we doubled down here, and the stock has just shot up. Now, again, we've only owned this for 3 weeks. but this is the one that's it's really had a nice run, and I think it's going to go a lot further because both its technical picture. Now, near term, you see it is getting a little overbought, so I wouldn't be aggressive here. But again, it gets back down towards 110 or so. I'm going to be, again, pounding the table again on the stock. And again, that tier 3 thing, that's what I'll be talking about. Telling people it's like, hey, that's been a good call for us. If you want to take 25% of your position off the board, that's fine. But don't pull the whole thing off because it's got a lot further to run. We can pick up a little bit more, on this on a near-term dip. But this is one that we were really going to watch for a long time. I think it's going to go a lot higher.
That's a great pick, Matt. Thank you so much for spending this time with us on a Sunday.
Thank you. And thank you. And good luck to everybody the rest of this year and the years to come. It's going to be a lot more fascinating times in the marketplace.
Very true. All right, Matt. We'll see you later. All right, guys. I'm going to hang out with you for just a few minutes to answer any questions you have about the subscription. So have at it. Let me know what you need to know. It is a 2-week money-back guarantee, 14 days. I recommend getting as much as you can, get as many tiers as you can, so you can get as many trade ideas, as many picks as possible. You can try them out. You can see if you like Matt's style, and if you don't, no worries. Give you your money back. How can we get these kinds of charts? Pretty much any brokerage is going to provide the same sorts of charts that Matt was using. He uses very simple technical indicators, nothing too crazy that you have to pay for anything special on. If you have Benzinga Pro, it's on Benzinga Pro. If you have pretty much any brokerage besides, I don't know, something really cheap, you should be able to pull up all of those technical indicators. Will you get an email with the Matt offer? Yeah, we'll send you an email afterward, so you can take some time to think about it if you're not ready. But that's going to be today that you'll get that email. So make sure you're watching your inbox today to get 30% off. All of the subscriptions that we have are annual subscriptions on this part of Benzinga. So this is 30% off of $97 for the first tier, gets you down to $67.90 for an entire year. So I always say that that's cheaper than Disney Plus is. So I'd rather be trading with Matt than watching The Little Mermaid. The one-time offer that you see on the page is just something that is a bonus gift. That instead of asking you to subscribe and pay us regularly for updates from our news desk, that is like a free, very light update on the stocks that the news desk is watching each morning. The Benzinga news desk team of reporters and analysts and researchers. So that's every morning. You get a little update before the market opens on what stocks to watch. That is separate from Matt's thing and just a little bonus that we're giving you. Where instead of signing up for a subscription, you can just pay $47 one time and you get that email newsletter for forever. Am I a member of Matt? I am for free. Get to see all of Matt's stuff. A lot of what I do is based on what I read from Matt. I use Matt's picks. I read everything that he writes, and when he does his strategy calls, which is the tier 3 for the subscription, I listen every single time. But I get it for free because I work at Benzinga. That's a perk, right? And and if I didn't work at Benzinga, I would pay for it, 100%. Same question. What about more education focused offer product? So this one is, I would say this is very education focused. The mantra here, and all of our editors for our subscription products here have this mantra, earn while you learn. So the idea is that you are learning if you want to. Some folks don't want to learn, and that's fine. Some folks just want to like just tell me the stocks and why you're interested in the stock. Like why? Tell me the stock. What's your buy signal? What's your stop loss? What's your entry target or your exit target? And Matt gives you all that. But he's also going into his trading style. I mean, he gave you some of that today, which is basically pile into winners, which is something I've really learned from Matt. That's what really works for me, honestly, on swing trading in general. I'm not looking for like intraday stuff because I'm not a day trader. I don't have time to. I have a job. Um, but when I have winners that are running and they're hitting their exit target and they're going past the exit target, that's when you start piling in. And I learned that directly from Matt. It's worked for me really well. So you get that. Can you teach us to set it up? So there's nothing to set up. When you sign up for it, it's very easy. This product is designed to be absolutely super easy. You're not learning a new software or anything. We already looked at plug. We already looked at plug. That's in the video. So Matt, every time he gives a pick, he says he gives you the buy price, he gives you the sell price, and the stop loss every time. And if anything changes or anything special happens, you get an update via text, via email. And if you join the third tier, which is Strategy Elite Level 3, every other day you're on a call with Matt where he's talking about all of his picks and all of the trades that he'll do in between. So an example of that was when he was telling everyone to get out of Tesla, and if you wanted to go short on Tesla, to buy puts. So people bought puts and made quite a bit. So like that's when you start to get into like 4-digit percentage returns. But those are, those are for aggressive folks, and that's why we have it at tier 3. Does Benzinga need an in-house pro electrician? I'm not sure. I will ask our head of electricity. Stock prices very high, question mark, question mark, question mark. We go options. Most of the stocks that Matt is talking about are double digits in cost, and then if they get into the triple digits, they're in the like first like 100 something. But if you're really worried, I got to be honest with you. If you're really worried about the price of a stock, one is you have options as a path you can take, and then two, I mean, it's all about percentage returns. You can buy one share of Apple and get a 30% return, or you can buy 100 shares of XYZ, penny stock and get 30% returns on the same moves. It's all about percentage. Do any of the tiers include options or just stocks only? Tier 3, we talk about option strategy throughout the picks. The foundation of this entire thing is Matt's fundamental and technical analysis on macro and micro trends going into a stock pick with clear buy and sell prices with stop losses. And then to extract more value out of your positions, you have the strategy calls, which is tier 3. And that's where he's saying, options in between, maybe pile in at this point, maybe start taking a little bit off the table. You're not going to get that unless you get to tier 3. That's the whole point of the strategy calls. It's the whole point of having them every other day with Matt. What software was he using? He was using the Bloomberg terminal, which is like 20 something $1,000 a year. It's used by like hedge funds and old school guys that have been trading on the floor forever or whatever. It actually doesn't look that good anymore. Matt's old school. Does the tier 3 at 557 include tier 1 and tier 2? No. You need to get tier 1 and tier 2 in order to qualify for tier 3. You're not getting tier 2 and tier 3 when you go to the landing page. You see those after you get tier 1. So like I said, you've got to go through the process. You get tier 1. The next page you'll see tier 2. The next page you'll see tier 3. And you can think about those as level of aggressiveness and the amount of time you're going to put into your trading. As you advance up, you're getting more and more serious. Yen, that's a really weird comment. And if you say something else like that again, I'm gonna have to block you. Sorry. Okay, yeah, you did it twice. She gone. If you would like to, okay, cool. I would like to subscribe. Great, I got the link for you. Join the party. It's fantastic. I promise you will like it. Boom, there you go. There's the link. How many picks a month? The first tier is 2 picks a month, which with these swing trades, um, that's kind of where you want to be. Jeez. Some people's kids. Is this monthly or are you obligated for a year? It is a month. It is an annual subscription. But the cool thing about that is that if you divide it out over the months, it's super cheap. Yeah. The discount, I'm pretty sure, is good for the day. But I don't know all the details on that. I'm just here to support Matt. Matt's my buddy. I'm here to make sure that he has a good experience. Yep, sorry about that, guys. That guy was weird. Does the program provide any information about option trading? Yep, totally. That's the tier 3. But it's designed to be honestly like there are easy opportunities exist in the market. And Matt is a person that's been around long enough that he doesn't waste his time playing games with stocks that are not high convictions trades. Um, so I'm really glad that we have Matt because we've been able to design a subscription that is based on, like, you don't have to think too much, is using just very basic things. You heard him talking about RSI, 200-day moving average, 50-day moving average. Those are like the 3 most basic technical analysis indicators there are. Tried and true, solid as a rock. Not trying to get fancy, drawing too much on his chart. Support and resistance, a few indicators, and a good understanding of what's going on in the economy globally, other markets, global markets, along with fundamental analysis of the company and the story of the company. So the idea here is that the trades themselves, these picks themselves, are a very solid foundation. And then getting into options trading so you can extract even more from these great picks, you get that on tier 3. The discount applies to every tier. The discount applies to all 3: tier 1, tier 2, tier 3. Does he short? Not really. Like there are some cases like Tesla, and I think there was another one. I can't remember what it was, but in most cases he's not going to tell you to short because uh, the odds are in the market. Stocks go up. That's like, just try not to bet against uh, the U.S. market. So he's and it's also like kind of complex. Like I said, we've worked really hard with Matt And I'm really glad that we have a guy like him who's able to find these consistently and explain them in a way that's easy to understand. We've worked really hard with him to make something that's very solid and straightforward. Nowhere man, you're not blocked. I see you, and I saw your lyrics earlier about butterfly. I can see you. Um, yeah, Ricky, you can do whatever you want, man. The subscription link for tier 3, you got to sign up for tier 1 and tier 2 first. All right, I'm going to drop the pricing and the link one more time in chat, and then I'm going to let you guys go and get back to your Sunday. I hope this has been beneficial. If you registered via Zoom and we're in the Zoom side of things, you will get a recording of this session. So um, I hope you enjoy it, and I hope you got something out of it. I know I always do when I get to conduct these with Matt. Cool, all good. All good, green trades. All right, guys, as always, happy trading. Protect your capital. Protect your capital. Don't go out there doing risky stuff. Don't trade what the neighbor's trading. All right. Thanks, guys. Happy Sunday. And YouTube folks, you guys are something else. I hope you guys have a good weekend. I'm glad it was beneficial for you over on the YouTube side as well.